All right. Well, here we go. End of the week. All-time highs for the US market. So I've been taking a look at, you know, basically recalibrating. So given that this could still be in play, right? That big long trend line, and it could still be in play just by the fact that this high might be coming up to backtest that long line. Okay. You know, to me, it still is a pretty good, accurate reflection of what's been going on. But I guess I'm looking at saying, well, really, maybe that's not what the market's telling us. Maybe the market's telling us this, right? Where really after the clean out here, okay, we've got a big long-term trend, and that then means that really the highs that we are potentially looking at are significantly higher, like up around 4,900, 5,000. So that, I'd say, unless we see a pullback below this trend line, all right, we are in line for good chance 5,000. That's what I'd say, given that this break hasn't followed through, that it has potentially formed another trend line here, support, and as I said, if it breaks there, then really I think we're kind of looking down here, possibly further, right? But failing that, the default at the moment really is new highs. One thing though I do have my mind on, my eye on, is it'll show up better in the normal lines, I think. When we look at all these, maybe in the bars, no, in the lines it'll show up better, a bit more clearly. When we look at all these moves, right, you know, they have got, you know, 1, 2, 3, 4, 5, and then they're off. So after the up and back, there is another pullback in them. You know, it happened there. It happened here, right, where we had, like, you know, the run up. There's a high, reasonable pullback, okay, a new high, but then another reasonable pullback, and importantly, overlapping, right, overlapping from that high to this low. Here, similar thing, where we had like a good run up. There was a high, a low, and a little higher high, and a low, and that low did overlap that high. It didn't overlap the low. There's that one. When we go back here, it's quite clear, big run up, big high, a lower high this time, a higher low, but certainly overlapping action. Even in some of these earlier ones, you know, you can see how it ran up, a high, a lower high, and another stab at the low. Didn't form another lower low. And even this little one here, these similar, like, little overlapping patterns, where you do have like two tops and two lows. You've got two tops, two lows. You've got two tops, two lows. Even here, you've got well, I guess either here or this one. You've got a couple of tops, a couple of lows. Now, here, you've got a couple of tops, a couple of lows. They're overlapping, right? Now, here on the grand scale, of course, we don't have all of that. We've got the run up. We've got 1, 2, 3. What we don't have is what's happened before, which is that, right? So I guess I am looking at that as the scenario for the market here, where I suspect that we will see a pullback at least to this previous high, which isn't far away, right? You know, like 60 points. Definitely to this trend line somewhere, okay, which could take it, work around these support levels, you know, 44.60. You know, potentially back to these levels. But the way things are going with the strength, that would be quite deep. And unless something triggers it, which I expect would be in the treasury market, then I think the way I'm looking at this now is that there is a trend line here which is intact, and that has shown, I guess, more resilience so far to the technicals than what had been up until this point. This has been a reset. It doesn't look like it's a reset to a low to really break this trend. It looks like it's just a reset to the bottom of what is turning out to be a trend here. So I'm looking for two or three things in the market here. One is unless it breaks this line, well, if this line holds, then we could be looking at quite a bit higher, like 4,800, 4,900, 4,500. So that's the one if this line holds. I am looking at a short-term pullback though that will overlap at least that. Okay, and I would say 44.50 is probably on the cards, like a reasonable target. That would be in line with the trend and also would be in line with some of these overlapping moves that we've seen when it has, a pullback, a little bounce and a new rally, as a high there, pullback, bounce and then a rally, as a here I guess a bit messier, it has a higher pullback, a little rally, a bounce and off it goes. Same thing here on a bigger scale. So that's what I'm looking at in the US market. It is still subject to what's going on in the bonds, and I guess that's the caveat, whereas if the bonds have a moment like they have in Australia, where this long-term trend is broken, and it is in Australia, then we are looking at a recalibration up to here, which could be substantial, which could be up to 150 points. It could be something smaller, back to this level here, of 2.2, like 220 points. But in any case, we are looking at, I think, higher bond rates, which will not bode well for the market. We can see it in the 2 years also more clearly, and this is really, when you look at this, the 2 years going back 30 years or whatever, they kind of turn around pretty rapidly, right? That's what they do. They recalibrate to these lower points, just as basically we get used to lower interest rates and wind up with more debt, so we can never raise rates back to where they were. But they do consistently come back to this trend line on these big pullbacks, right? The last big one was 2018, and that's what coincided with that 20% drop in the equity market. Here, I'd say pretty much without a doubt, we are definitely headed towards maybe this point here, right? That's the end of the year. Okay, maybe sooner, but I'd say we're definitely headed towards 130. And if you take the view, which I do, that this really is the end of this cycle, then we could be destined for as high as this previous high, which was in 2018, which is about 280. And now that is actually in line with really where inflation is expected to be over the longer term, and with inflation getting away, where you'd think rates would need to be raised to help keep it under control. Now the interesting thing about that is if this 2-year rate goes to, like, say 280, right, then that will very likely flatten the curve, because I'm targeting somewhere between 230 and 330. The middle is like about 280, right? That would flatten the curve. Now, when those 2s tends flatten or invert, that is a sign of bad things to come in equity markets, and is what has happened before, particularly in the dot-com bubble bursting. So that's pretty much it for today. Just quickly, the Dow. The Dow is just really trending sideways at the moment. That's the way I see it. Take out a bit of this noise. I mean, really, it's a toss-up between whether this sideward trend is the dominant story, or whether, I guess, similar to the S&P, whether it's going to obey this sideways trend or whether it's going to respect this trend line. But it's certainly a risk of going higher, like the other equity markets, again subject to the bonds. The Nasdaq, which of course, as people say, is very subject to interest rates. It's got a similar, upward trend there. This longer one that I'm looking at is the one that goes back to the post-GFC thing, and you can see how we've busted well above that. And the last time this happened, of course, was back in the days of the dot-com debacle. As you can see it there, similar where it blew out after a much longer trend up. So that was 81. That was 20 years, right? And then it kind of blew out. And of course, when it blew out, that was when the curve 2s 10s flattened or inverted. It certainly came close, right? So the thing I've got in my mind is this price action, not dissimilar to that price action. This price action bombed when the 2-year rates rallied, right? Which is basically like here, right? That kind of rallied and the curve flattened. Okay, let me just get back to a non-linear scale. So that's coming up to that was it, right? That was like end of 2000, right? So that was a precursor to the dot-com thing, and then of course rates came down afterwards. So that was a precursor to dot-com. This was a precursor to the GFC, right? This was a precursor to the 2018 correction, right? If it does it again, what's it going to be a precursor to? Okay, it could be a precursor to, a nice end of COVID-free money supply. And again, this could be, could it be as soon as the end of this year? Look, I think it could, right? When I look at the time scales on it, it's a bit hard to tell with all the time scales. But I guess the thing is, when they move, they can move pretty quickly. You can see how quickly it moved down from 134 to 30 points. It won't take much for it to do. I mean, that move kind of happened like in a month. Okay. This move obviously happened pretty much in a month as well. So they can be very short and sharp. So with those 2 years poised to rally, which I'm quite sure they will, the 10 years poised to rally, but not as far. That will mean the curve will flatten. That will be bad for the NASDAQ, and potentially very bad for the S&P, and it could see, from wherever it ends up being, like a 20% fall, right? And to me, I mean, I'm kind of still got in mind this range here. If I can find my little pattern here, in that 4,000, give or take a bit range, right? When we look at the dailies, we can still see there's a bit of a gap in there, right? And I think if this market, give it a bit of time, could rally higher, could have a little correction down here. That's where I'd kind of, judging by history, what I'd expect. It'll have like a pullback somewhere in this range. Could then easily go and make new highs towards the end of the year. 2-year bonds rally, curve flattens, bad for the NASDAQ, bad for the equities, 20%, pretty easy. Look, that's it for today. We'll see how the week goes. Okay, ciao.